All right. Next up, we have our industrial sector. And here are my notes there. So we have Fastenal, we have ETN, which is Eaton, and then we have IEP, which I'm not very familiar with, but let's take a look at them here. Okay, so this is Fastenal. As you can see right away, they've actually made money over this last 12 months. And again, that's the one thing that I was really looking at and really concerned about, outside of other things, of course. But yeah, they were able to actually increase their profits during this COVID thing. And so I think that's a really good sign of a well, not only managed company, but well situated, right? Because if you're in a position where you can withstand, something like COVID, which a lot of people will say it's something of a recession, then I think we're in good shape, at least over the next 12 months. Okay, yeah, Econ Enterprises. Again, not very familiar with the company, honestly, but as you can see, over the last at least 3 years, they have not been able to turn a profit at all. And so, that's something that we look at and we're like, do you invest in a company that can't make money? That's tough. I mean, we all know that there are companies that don't make money that are doing great, right? Amazon for a very long time didn't make any money because they wanted to gain market share. They were more concerned about getting people to use their services than they were about making money. But now that everyone is using their services, they're able to generate a huge profit. And there's lots of examples like that. But again, we're investing in these huge companies that's been around for at least 10 years. And my goodness, if you can't turn a profit after 10 years, being one of the largest in the U.S., then I think that says something, right? So almost right away, we were like, no to IEP. Eaton is the company that I am a bit more familiar with, and just looking at their earnings, they lost money. They were able to return a profit, but I mean they're almost down half. And so the question becomes, what is Fastenal doing different than Eaton? Why is Fastenal in this position where they can actually make money during COVID, whereas Eaton is losing money? And so we look at, some of the other factors that go into this. We're looking at the current ratio. We're looking at price to book, things of that nature. And you can see right away, Fastenal has much more cash on the books. I mean, they are really handling their business when it comes to cash and keeping their debt low. The interest coverage is something that we haven't talked about before, but interest coverage is literally how much interest they're paying on their debt, okay, and how much cash they have to cover that interest. And most of this cash is coming from net earnings or net profit, right? And so, they're doing just an excellent job at managing that. Now, I said I was going to mention this in another video, and I will, but I did want to talk about it here since I have this graphic. This is an option chain, okay? This is the option prices for Fastenal, okay? Now, this is considering that we're going to hold this option until February 2021, okay? Now, again, we can look at January, we look at February, we can look at March, April, May. We can go all the way out to January of 2023 if we wanted to. And generally speaking, the further out you go, the higher the prices get. Okay, so let me explain how this works. Currently, Fastenal, No, go here. 20 A's. There we go. All right, so currently, Fastenal is at 49.52. That's the current price. Okay, a Fastenal, 49.52. Okay, and so what you have here is at 49.60. Okay, I can sell a call, which means that I can sell this stock at $49.60, and someone will give me $200. So I want you to stay with me on this. Someone will give me $200 if I were to sell Fastenal at $49.60, and I can buy it right now today at $49.50. Let's look at the math on that. Okay, look at the math on that. So, if I buy 100 shares of Fastenal, which we are, okay, 49.50 minus 49.60, that's 10 cents. Okay, 10 cents times 100 shares is $10. Okay, so I can sell Fastenal at $49.60, and I will make a $10 profit, and somebody will give me $200 in order for doing that. Why is someone doing that? Well, the reason why someone is willing to give me $200 to sell Fastenal at $49.60 on February 2021 is because this person thinks that Fastenal is going to be at least $51 by the time February 19, 2021 comes around. It's going to be more than $51 actually. So why is that beneficial for them? Well, because if Fastenal, let's say, goes up to $54 by February 19th, 2021, okay, they can make $440, and they're going to pay me $200 to do so, which means they make a profit of $240. And all they did was spend $200. They didn't have to buy the stock. They kept all their cash in their pocket. All they did was give us $200, and by February 19, 2021, they stand to make a profit of $240. Okay. Meanwhile, we're getting a profit of $200. Now, with that being understood, as you can see, as the price gets higher and higher, the price that we're able to get gets lower and lower. So if we were to contract someone to sell Fastenal at $57, they'll give us $10 today. Okay, and that's exactly how this iron condor strategy works. Okay, so we're going to buy 100 shares of Fastenal, but then we're going to sell a contract to sell Fastenal at a higher price, maybe 54, maybe 57. But the point is, we're going to sell and make that money on that contract. Okay. Now, on the other side of things, is we're going to, let's say Fastenal drops in price. Okay. Let's say Fastenal drops all the way down to $37. Okay. If Fastenal drops down to $37, then we will want to buy more Fastenal. Okay, because remember, we're investing in this company for the long term. We believe in this company. Unless something crazy happens, we're going to stick with this company. And so if the stock price drops, we're going to buy more at a cheaper price, because that means that we'll get Fastenal at a cheaper price. And let me explain how that works. It's called dollar cost averaging. Okay, so right now the stock price is $49.60. Okay, and we're going to buy 100 shares. Okay, so that means we're going to spend $49.60 on Fastenal. Okay, all right. If Fastenal goes down to, was it $37.10? We're going to buy 100 more shares at $37.10. Okay, and that's $3,700. Okay, but what's happening is that now we have 200 shares of Fastenal. So we're going to take that money and divide it by 200, And that means that we actually own Fastenal at $43 a share instead of the $49.60 that it is now. Okay? And so that's the reason why we'll want to buy more at a cheaper price. Okay? Now, if we do that, someone is willing to pay us $10 in order to buy Fastenal at $37. Okay, well, why are they going to do that? Well, they're only going to do that if they think that they'll be able to sell Fastenal at a cheaper price. So if Fastenal drops to, let's say, $36 by the time February 19th rolls around, we've already contracted to buy it at $37. So even though the price is actually $36, we have to pay $37 for it. Okay? And so that's the reason why people are willing to pay us in order to do that. Okay? As you can see, the closer that the price gets to what it actually is, the more money we can make. So someone is willing to pay us $135 if we were to purchase Fastenal at $47. Okay, I'll tell you right now, we're not going to purchase Fastenal at $47. Fastenal is going to have to drop pretty low in order for us to buy more. I wish I could show you how the software works and how that gets calculated, but that's just not available right now. But the software will tell us when to buy and when to sell and when it's profitable to do so. And so that's how that works. So long story short, we did look at everything, even though IEP has a better beta, which means it performs better when the market is not doing so well. Fastenal is just a better company throughout. They have less debt, better profit, and a better return over the last 3 years.